Hello and welcome to the another topic, the cash flow statement. The cash flow statement is one of the important financial statement, and here you can see I'm on the Wikipedia page. This page very well define what's the cash flow statement and other stuff here. So let's see what's the cash flow statement. So let me bring my pen. Hopefully, so the cash flow statement is also known as the statement of cash flow, right? So pretty much we learned in the last video that the income statement is where we receive the revenues and expenses, but the cash flow statement I treat as really the where we treat the cash inflow and outflow, because it's not based on the accrual principle. It's exactly show what's uh, or it shows the health of the organizations. So from the financial analyst perspective, this is one of the very important statements, for one of the important statement. For example, let's say in the income statement we have the, let's say we have the revenue of or let's say we have a sales of $100, right? But if we have the account receivable of $25, then in the cash flow statement we'll say, okay, we only have $75 because the account receivable is still, we haven't received the $25. But in the revenue, you might notice, because of the accrual based principle, they said it's $100. So that's pretty good, on the cash flow statement, because we can see what's actually we really worth it, rather than based on the accounting accrual systems. So let's focus on the cash flow statements. Even on the definition, it's mentioned here, the cash flow is concerned with the flow of cash in and out of the business. So that's the one thing. And second, okay, so now similarly to the let's go to the next. So what's the are the activities, or let's say how the cash flow statement are categorized. So basically we have like in the cash flow statement we can have the cash flow of the operating activity, which is for called cash flow from operation. And then we have a cash flow from investing activity, and then cash from the financing activities, which is here. So we have three cash flow. So when we say the cash flow from the operating activities, it says basically is the name is sound, and also it's simply means that what we do from the day to day, or the production activities from the operations, what the core business. So how much cash it able to generate out of it. From the investing activities is mostly like from the sale of the plants and machineries, from that perspective. And also like sometime is also not sometime, but it's short term investment, like in equity or debts, in some other companies, that can be also treat as investing activities. So here you can read it. I am just so giving the example from the Wikipedia, because it's very nicely written here. So rather than writing myself to the PowerPoint. And it's also just want to bring a point here, that the flow of information, it can be in the Wikipedia as well. And for sure people go for the basic concept. We can even look here, and which is pretty. Okay, so here you can see from the again is highlighting the same thing, cash flow from the operating, investment, other activities, and it defined. And also it gives some of the example for of the operating activities. So the example what it's giving has us like a operating activity, production, sale, or delivery of the company product as well, collection. Okay, this is pretty much what I describe above. And on the investing activities, it says the purchase of sale of assets, and so on the financing activities, pretty much is also straightforward. The financing means if they share, let's say they issue some shares or issue some bonds and generate some finance. And for sure, or on the other side, if they are repaying, repurchase the company stock, then or they repay repayment of the debt principal, which is like you can think of as a bond, right? If they pay back as well. So these are the financial activities that also covered here. Now how to trigger that stuff, right? How to log the entry into the cash flow statement, or how we can come back, prepare, that's a better word, right? How we prepare the cash flow statement. So basically there are two ways to coming it. First is the direct method, or another one is the indirect method, which is here the number two. So I think this is going okay. I'm not sure why this is like this. Okay, but direct, the pretty much if you notice here what they're saying, indirect method is universally used. And if we go from the FAS by 95, they required, if you prepare only the direct method, but they still require the indirect method, similar to the indirect method the company is using the direct method. So this means we you can do the direct method, but you have to prepare the indirect method. And both methods, once you get a grasp of it, it's not very tough. So pretty much let's come up with some I'll show you how it is. So this is very nice these are the rules given here for the indirect method. So basically indirect method what they is saying, our base is the income statement, right? Or the net income. So what we'll do, we take the income statement, the net income, and then we start reversing our income statement activities. For example, if we reduce in the income statement, if you remember in my last video, if you haven't watched that, you can go and quickly watch. It's not that a very big video on the income statement, but just to bring the idea here that we reduce the, like for example, depreciations, right? But here in the cash flow statement we add back the depreciation. So why we are adding the depreciations? We are adding the depreciation basically because we haven't paid to anybody the depreciation. So this means no cash is out. So we are bringing back that stuff back. And also if we purchase, let's say, any plants or any, then we add that. If we increase any asset, we bring that, we did the opposite effect basically, because if we didn't do that thing, it might have, because of that, have higher cash flow. So that's the reason. So for example, the rules are also there. So if this is the rule for the uh, indirect method. The rule is very simple. If our current assets are non-cash, right, if we are increase that, we we decrease to the net income adjusted is decrease, right? Because for example, when we purchase any plant and machinery, we reduce the income statement, right? And if there is a current liability, the liability is increase because of that. So for non-cash must be added back to the, therefore they're saying it must be added back to the net income, such as the expenses may represent on the balance sheet, such as decrease in the long-term assets, or thus decrease in the so let's take example. I think when we take the example, it will make things a little bit more clearer. So this is a very nice example. It's just a fictitious one XYZ cash flow statement. All it's doing that, okay, it's take the cash, the income statement for from the this 3 year 20, 10, 19, and these are the 3 years they pick it up. So basically what they're trying to do here is now not for the operating activities, they add the depreciation. As you notice, they get the depreciation. I already explained the reason earlier as well, because the cash is not out. Adjustment, let's pick another one. Decrease in the account receivable. For sure, what do you mean by decrease in the account receivable? Decrease in amount receivable means account receivable only get created when somebody didn't pay, because that's still we need to pay. But if something is decrease on that one, this mean we receive the cash. If we receive the cash, we add it up. The next is the increase or decrease in the account payable. Account payable means if we are increasing the account payable, this means we are not paying somebody on time. This mean we have cash in held a lot, right? So that's why we are increasing, we are adding it up here. Okay, on the liability is not there, or the other operating activities, so which is we are decreasing it up. So this is our net inflow from the cash. So it says it's very low here, but this is very high. The next is on the similarly on the investing activities. Seems like we have used the cash flow from expenditure and some dividend paid. So since the dividend is paid, the cash is going out, it's get reduced. Sale of a stock. So we did the sale of a or increase in a debt. So increase in a debt, okay, the now the debt is increased, it's get added here. So this is the repurchase of a stock, basically what is saying here. So repurchase of a stocks uh, is treated as a negative here. So similarly, like plus and minus is not initially it may be a little bit tougher, but once you do this one or two times, it's not that hard. So end of the day, what treats our cash flow to go up, what treat our cash flow to go down. So if you are a CFA level candidate, you have a nice rules given in the book as well. So for example, 2019, these are the rules they mention here. So you can go over it, but otherwise for the journal who are not a CFA candidate or just learning the rules, they can also go the, or if they're a student, they can look into their books. But otherwise, uh, is I think the general idea which I provided, it should be more than enough. Mm, uh, so here for the CFA candidate, you can see the adjustment to the net income, right? So they are very clearly mentioned the rules here. So just go over it and practice. Hopefully, once you do one or two times, it should be a few times. It should be fine. Okay, if you have any doubts, you can put comments or questions. But otherwise, for this video is just for the general audience who wants to understand a little bit on the cash flow statements, what is about and how it's prepared, and not for the in-depth studies for the CFA candidates. But if you still have any questions, or if you like this video, please do like it and subscribe to my channel. Thank you very much.